Joining us this morning on Studio 10 is financial expert Dale Gillham. Hi, Dale.
Hello. Finance expert Dale Gillham from Wealth Within. It's nice to see you again.
It's amazing listening to a professional trader who's doing what you're aspiring to do and hearing it firsthand.
Too many people ring me up and say, hey Dale, I want to make quick money, but it's not about getting rich quick. I think we can go for about 4 hours, but I'm not sure my wife would like that. So
I'd say congratulations for putting your time and effort out there, because you probably don't really have to do it. You're successful traders in your own right.
Thank you very much for opening up my mind with trading.
So of course you can succeed, of course you can, and you're the only one holding yourself back or succeeding, and that feels very empowering actually.
A quick reminder before the show starts that this live stream is an educational tool, and as such your personal circumstances have not been considered. We hope you enjoyed this week's show.
Good evening and welcome to Wealth Within Live, the Australian stock market show where you ask the questions and we give you the answers about all things investing and trading. The stock market's looking fantastic right now, and we've a very special show lined up to help you understand more about how to profit from it. Tonight we'll look at the world markets and give you our thoughts on where they are headed. We'll also get into our topic for tonight and share with you why the Australian stock market is poised for a record run. Like every show, we'll also answer your emails, take your questions, look at the stocks that you're interested in, give you our expert opinion and a whole lot more. So sit back, make yourself comfy and get ready for another great Australian stock market show. Hello, I'm Janine Cox, Senior Investment Analyst here at Wealth Within. Joining me tonight, I've got Dale Gillham, of course, and we're Australia's most trusted stock market educators.
you're a senior investment analyst, is that what you just said?
I did, yeah.
I just call you the best female trader I've ever met.
Oh, thank you.
But that's fantastic. It's good. We had a lot of feedback from the last show.
Did we? Did we get a record number last week?
Yeah, we did actually. We got a lot of people watching it, and a lot of people watching it after the show. I think by 7 a.m. in the morning, we'd had a record number of people actually watching the show. So thanks, guys, and thank you for telling your friends about it and getting it out there, because really, Janine and I put a lot of effort into this show, getting it ready to give you the information. It just doesn't sort of magically happen. We don't just walk in, sit out, put my tie on and sit down and start talking, although we both can do that.
We sometimes argue about what we're going to share with you too.
We argue a lot, sort of like an old married couple sometimes, isn't it, where we're having a big discussion. But it is exciting, and we do want to bring you stuff that you want, and that's really what's important for you or for us, to give you exactly what you like and what's helping you. But one thing we can't do is, obviously with YouTube, there's a lot of depth we can't put into what we're talking about, and often, Janine and I goes, I'd love to talk a lot more about that, but the depth will just spin your heads, I suppose. If I'm, in terms of a scale of 1 to 10, I often say to people when they're talking to me about, trading and the show, and go, wow, you're teaching me to trade. And I go, look, if I'm a number 10 and you're a number 10.
That's about that much of what you need to know.
Well, it's a 15th of that much, pretty much. But it's like, if you consider Janine and I to be 10 on the scale of how good we are in terms of a scale of 1 to 10, then what we're talking about on this show is like not even 1 on the scale of what we're teaching people, what we do teach people in our diploma course and everything else. And so, sometimes I've had people say to me, oh, you're teaching me how to trade. I reckon I can trade full time by watching your show. And I went, seriously? Like
then you don't know how to trade.
That's like you don't understand.
Know what's really involved.
Yeah.
I guess it's you only know what you know.
Yeah, when you
How
don't
can
know
you
what
see
you don't
further,
know.
Yeah, than where you're at.
Yeah, and people think, oh, well, I learnt this and I learnt that, and it's so fantastic. And what we're teaching you is solid stuff. And
it's the
really
basis for
stuff.
what you need to know. It's a good foundation, really. It's the start of it.
But we're just scratching the surface. And really, that's why those people, they, for want of a better way of saying it, without being rude to people, is they don't even know how ignorant they are of what they don't know. It's that point is like, I don't know what I don't know, but they're thinking they can trade full time on what we're talking about. You can't. I don't think there's one show in the last 6 months we've actually said what a buy and sell rule is.
Oh, I think I did, remember?
Did you?
Yeah, I
Which show?
let it slip.
No, don't even tell them which show. Let them watch them all. But I don't remember either of us talking about a buy and sell rule, about what our rules are around buy and sell rules, and exactly what we buy and what we buy. No.
Yeah, okay.
And if it was you talking about one, it would have been a very loose way of doing it.
Yeah.
And yet, what's the important thing you need to understand first is direction, strength,
The
and
big
where to buy.
picture.
Yeah, and that's what we talked about last week, and we're going to talk about it this week. But
Yeah, the monthly chart's great for that, isn't it? You just need to look at the monthly charts and make sure that that's what you're focusing on initially.
and I'm really excited about tonight's show. I think it's going to be great. But before we get stuck into the show, remember that we can help you. We do need you to put your questions into the chat box, which is onto the right of the screen. So do that. Remember, you've got to be logged in to do that.
Moving on, it's the third Tuesday of the month, so that means that we're going to have a look at the world markets. That's exciting, isn't it? So let's get on to the charts. Can we bring up the Optima charts, please?
Okay. So what do you got on the screen? We've got the world
On
indices.
the screen, okay. What have we got there? We've got the Hang Seng, Dow Jones Industrial Average, the Nikkei, which is one of the favourite ones to look at, the DAX, which it's fascinating to see how that market's gone over recent times, NASDAQ, Australian All Ordinaries Index, which you guys all know very well, Straits Times Industrial Index, Shanghai Comp, S&P 500. So I just want to have a look at the one that's performed most. So this is the percentage change in the last month. So we've seen the Nikkei just really rocket off, a 6.2% growth there. The Hang Seng 5.4. But if you look at the charts of these markets, you'll see the significant declines that they've had prior to these moves up. Which is fascinating. So Dale, you've just sorted it so that it's large. You know, we're talking about the largest growth down to the lowest growth. And look at the Australian market there. All Ordinaries Index up 1.25%, but we think that there's further upside for the Australian market.
This is not the last 30 days, it's the calendar months from 1 September
to the current date in September.
Yeah. And if I change this to yearly, just quickly,
yep,
you'll see from 1 January. So this is 1 January, the NASDAQ's done really well, so the Shanghai, the S&P.
So look at the switch around though, in the Hang Seng and the Nikkei were down towards the bottom.
Yeah, they were, and the Asian markets are a lot different than the US market. And this is really where I get a lot of people, you get all the media, and I was talking about this on the US market report yesterday with Jim Beach, which we do every single Monday. So if you haven't seen it, we do it every Monday, and it's syndicated across the US. And it was like, when you listen to the media, all we should be looking at is the US market, and yet we're more aligned to the Asian markets, not the US market. When you look at these sorts of things, is our market moves a bit more than they move.
Yeah. We've moved so much faster.
But we've moved faster
over the year, haven't we? Look at the All Ordinaries Index up 18.8%, which is great. So people think that they can make more money out of the higher risk markets like the Nikkei and the Hang Seng, but it can be a much trickier market to predict than our market, I think.
Oh, it is, and because it's a lot more volatile. But the scary thing about this is people look at that and say, well, the S&P 500's done 19.59%, so let's get into the US market. But what they don't realise is over the last 2 years, since January 2018, the S&P's done 9%.
Okay.
This 19% is the last few months.
Yep.
So it's not over that time.
Well, that was the year. That was year,
this is year to date.
Yeah, year to date.
Yeah, but it's done most of that over the last few months.
Yeah, because it's done a zigzag pattern, hasn't
correct.
it?
Yeah.
So
and if we go back 4 years,
and then come right back up to where it was trading at.
Yeah. And over the last 4 years, the S&P's done about 40%. So this is the thing, is some of these statistics get people a bit. They go, wow, I'll get into that. And it's like, by the time they figure out they're going to get into it, the run's already over.
So what you're saying is that they hear a quote of a percentage or someone talk about it in the media and then jump on it. But we're showing you the same thing, but looking at the chart gives you a totally different view on things.
So let's look at the charts quickly. So we'll go to the Dow. The Dow's the first one next to where you are now. So that's the Dow, and that's what I was talking about.
So you've got the weekly chart up there. Should we just have a quick look at the monthly?
Yeah, fine.
Flick over.
You can flick over whatever you like. You're in control of the mouse.
I am, but I don't seem to be at the moment.
It's like the controller, the remote controller.
It's controlling me at the moment. All right, so looking at that, we can see there long term, I mean, the US market has made a really steady incline towards that 28,000 point mark. And now looks like it's trying to go higher, but it's an interesting pattern that's forming on the chart, isn't it? Like the highs are getting higher, but they're a lot slower than what they were along these sorts of moves. So does that mean that there's, potentially another move up and that's the end of the run?
Well, that's what I was saying. When you look at the statistics we just saw, they look different. They get people going, wow, the Dow's moving fast, the S&P's moving fast, I'll jump onto the US market. But when you look at that, it's actually slowing down.
That has slowed down a lot.
Where our market looks a lot more bullish than that. So that's the difference between the two. So again, people who are ill-experienced will actually get tied up in short-term emotions. And we're going to show you how to sort of avoid some of that tonight.
Okay, looking at the DAX there, we can see the similar sort of thing with the US market, and I'm on the monthly chart here, as you can see. It's good practice. And looking at this, it's made new all-time highs, but has slowed down as well. A lot more volatile over recent times. The FTSE, looking at the FTSE, it's tried to recover back to that high. The whole Brexit scenario caused the FTSE to go into a bit of a tailspin, and we saw this pullback in August. And it's trying to recover now, but it's taken out this lower trough, this higher trough in June 2019, and so this month of August has pulled back below that low. That's generally not a great sign for a market, but we need to see it get back above this April 2019 high for it to be on its way again. So at the moment, it's just sideways.
It's holding up all right, isn't it?
It's holding up okay. I mean, there's really strong level across that 7,000 or 6,950 point mark, which is good to see. But if it traded back below that, then I'd be thinking it's more or less going into a decline and
absolutely.
to stay away. So Hang Seng, see what we mean about the volatility of the Asian markets. Huge volatility, just to give you a bit of an idea here.
I think I should have cleaned these charts up. There's a lot of stuff on there.
Yeah, I think you're showing them some GAN and all sorts of stuff in here.
No, I was doing stuff for our students, so
okay.
That was
a recording, was it?
Yeah.
Okay, so looking at this here, we've got a bit of a move down here, 66%. Okay, and now our market pulled back about 55% during the GFC.
Or 52?
I think it was close to that, 55. But looking at that 66.6% on the decline, and that now it's actually just recovered through to a new all-time high, but it's trading below that level now. So that's what Dale was saying, is Asian markets tend to be quite similar to our market. The Hang Seng has looked very similar to our market in terms of the overall pattern. And this is another thing why Dale talks about looking at the broader picture of the market, because it gives you an impression of the type of stock or market that you're trading and the personality of it. I mean, it'd be a bit like, you wanted to go on a date with somebody, but, you see their photo and you think, oh, they look nice, and comments about them, but then you don't know what the history is and what they've done in the past. But the chart actually shows you what it's done, what that market's done. There's no hiding this.
Don't judge a book by its cover.
Yeah. Straits Times Industrial Index. So we're looking at bit of volatility, huge volatility across the index. We can see that it's really struggled to get to a new high. So November 2010, since then it's failed that. So we need to see this index get above this April 2019 high to know that it's going on. Now, all other markets have made new all-time highs, so I'd expect that it would eventually go through it. But only time will tell.
Singapore is really going ahead well at the moment. If you look economically, they're great for businesses, supporting business growth. And then look at the chart; it's not going there. It's really held back for whatever reason it is. It's being holding back there. But I
haven't studied this in great detail. Just looked at it for interest's sake more than anything.
Yeah, that's fine. was looking at some of the economic data out of Singapore and recently, and talking to one of our students who's into mergers and acquisitions and all that sort of stuff. He's now moved to Singapore permanently, and I was chatting to him only the other week, and he works for some of those big firms looking for capital raising, the technology sector and everything else, and he said it's booming over there. So to me, that means it's going to play catch up pretty soon.
Well, look out for that. And Shanghai Composite. Very interesting, this chart, and I find this fascinating to study.
Isn't it, China? It's interesting.
Oh, look, if we see a strong move above this high here, this is actually July 2019, and you'll note that I'm talking about August and July highs, April this year. These are really important milestones for any market. Now, that one is going to be really important to see a nice strong close above that level. Now we've got the S&P 500, one you'll all know.
That's Johnson & Johnson you're on now.
Oh, I've flicked to the wrong one, have I? Where are we going?
No, that's just the watch list. So you finished all the stocks.
You didn't. I finished. You haven't got the 500 for me.
I went through Johnson & Johnson, a few other stocks the other day actually.
Because the Dow's only 30 stocks or something, isn't it?
The Dow's 30 stocks, and Johnson & Johnson is part of that. So it's also Johnson & Johnson is one of the top 10 stocks in the S&P 500. So
we've got S&P 500 in here, so we should have a chart for them up there.
Yeah, we do. It's the SPX, so it should be up there, but it's pretty similar to the Dow. It's not a lot of difference between that and the Dow.
The overall
there's a little bit of convergence between the two occasionally.
Yeah.
But pretty much there's the same sort of thing.
All right then. So we've done that. We've finished that now, and we're moving on.
Okay, so let's go into some of the emails that we've got. So we've got about three emails, I think, this last week. So thanks to everybody that sent them in. Now, the first one is from somebody who was named after me, a person called Dale Thomason. So I'd like to say
No
that.
favouritism at all.
No favouritism. That's why he's first. He says, "Afternoon, Dale and Janine. Could you please review Citadel Group, CGL? I don't own this." But so we'll bring that up at this point in time, Citadel Group, and we'll have a good look at this.
All right. Now, there's no surprises which chart we're going to look at first. So here we go. We're looking at a massive decline here on Citadel. So a fall of, okay, what have we got there, Dale? About, what, 60% or so?
Yeah. Dale's saying he's been keeping an eye on it for the last couple of months, and from what he can see on the monthly chart, it might fall to as low as $3 or potential further, and he won't be buying it until it shows some improvement over the coming few months and rises above $5. So he's doing some good analysis on it.
Okay.
Saying he's waiting for it to fall to that low of $3 and then waiting for it to show a new uptrend. So I think that's smart. You know, that's why he might have a 4-letter Christian name, but he's quite smart.
Okay, now why the $3 mark? That's what I'm interested in, because
he doesn't explain it, but then that's okay.
Now, unless there's something awry with the chart, there's a big gap in the chart. The first thing that I would do is obviously check that the data's up to date, and that's what we tell our students when they're doing their analysis. But stocks will often come back and fill a gap, especially on a monthly chart. So the risk on the downside is that it could come back to that level.
Yeah, absolutely.
If it stays where it is and finds support where it is, which it may do, I mean, there's some support levels across here that might be important for it, but you'd really want to see it get moving in the next month or so if it's going to get going, because it's already taken out that low in June 2019, and to me that looks weak.
Yeah, but I think the smart thing is it's regardless. Like I had somebody today on the YouTube channel with a comment asking me about a pretty ordinary stock. You know, they bought it and it's fallen ever since they bought it. You know, and when will it go? And they were asking when will it go back up? And I went, well, you're asking me when you're going to be back in profit. Get your money back. That's what you're asking me. You're not asking me how's it going to rise.
Okay, so you want people to be direct with their questioning.
Well, no, that's the question we get so many times from people, isn't it? It's like, well, when's this going to rise? Well, I said to him, well, can I ask you a question? How long's a piece of string? Because it's not about whether the stock rises or falls. It's what your process is and what you're doing about it. And Dale says, well, I think it's going to go to $3.
Yeah, because
but I'm not going to buy it till it comes back up.
As an individual, when you're in the trade, it's all about the fear of loss, right? If something is in loss and losing more, or waiting and hope and pray that it's going to come back above.
Yeah.
But in reality, what you're missing is that's one trade in a whole series of potential trades that you ought to be making if you're active in the market, but you're making it like it's everything.
And it's not. It's just a stock. And, you know, I mean, you don't compound a bad trade or a bad entry into a stock. You shouldn't have been in the stock in the first place. Or people get into stocks they shouldn't have been in. Then they hold them as they're falling, and then they sit on them for ages and sometimes years waiting for them to get back up to their buy price because they don't want to realise the loss. Whereas realising the loss is the best thing that you can do. The quicker you do it, the better, because then you can have your money going somewhere else. And would you rather be in another stock going up 50, 100% than sitting in a stock that's losing you 50, 70%?
So what you're saying is set a stop loss and just be black and white about it.
Yeah, it's too emotional. They're going, and it is. It's just an ego thing for us guys. It's like, oh well, I got it wrong, so I don't want to realise the loss and admit that I've lost money and I did the wrong thing. You know.
Well, from here, I mean, it doesn't look much, but it's another 33% down potentially to come
Correct.
back.
Now he's not in this, and as I said, that's what I'm saying.
I mean, it may not fall to that level, but it could.
No, but Dale's being smart. He's saying, I'll wait for it to fall and come back up again before I buy it. So that's what I'm saying is he's got a good process. Now, he may not have his entry and exit rules perfect yet.
Yes.
But at least he's waiting it to go from $3 to $5. So that's, you know, $3 to $5, that's a fair chunk. That's about 60% move of $3, isn't it?
So you're being kind, aren't you, in this situation?
Well, I have to be. He's got the same name as me.
I know. I was thinking there was a bit of favouritism there all along. Looking at this, you can see we've got a nice trend line there. Down there. I might even be able to get a tighter one in there, not sure, maybe not. The students out there, you tell me whether you can.
They already know.
So looking at that, we could see it to close above the line at some stage. It's possible.
Let's move on to the next email.
Okay, ready?
Yep.
We've got another email
you're
in
in
here
charge.
from Craig, who said, "Hi Dale, I enjoyed the show and have purchased your books and videos last week.
Awesome.
I took out positions in Rio Tinto and FMG. Position sizes were 1% of my portfolio. The materials sector on the weekly and monthly chart looks good after bearish month in August. Both stocks have turned and are on an uptrend on both the weekly and monthly charts. Now I've set a 10% stop loss on if my trading goes wrong." Craig Wallace. Good to set the stop loss, mate. That's fantastic to hear.
I'm a bit confused.
Why is that?
Because he said his position size is 1% of his portfolio.
I thought that you would pick that up.
Like, that's not even close to what we teach in the book, or what I teach in the book. He might have been a typo. He might have meant risk with his 10% stop loss is 1%. If that's what you've done, Craig, then that's fantastic if your risk is under 2%. But if your position size is 1%, I think you need to read the book again, because what's the point? You're not going to make money having, you've got to have 100 stocks in your portfolio at 1% position sizing. And that's way too many.
Maybe it was a typo. I'm going to give him the benefit of the doubt.
I'm going to give him the benefit of the doubt. He doesn't have my name, but I'm giving him a typo.
All right. Now, I've just brought up one of the stocks. If we can switch to Optima, that'd be great, just to have a look at. Now, okay, he's got 1% in there, so he's not making much on it in the overall portfolio if it is 1%. And look, the stock is still looking quite strong. It's just recovered from a big pullback here. So then it's a question of, okay, you know, if you've only got 1%, how much could a rise of 10%, say, affect your overall portwoportfolio? It's working those sort of things out and then rationalising that for yourself. But at the moment, it looks good, coming up to resistance. I would prefer to see a pullback, but FMG is a type of stock that could just rip through any level.
Yeah, it could.
Yeah.
So let's have a look at BHP and Rio. They were the other two. Rio was it? It's already
Rio?
there. It's already there.
Have you put it in there already?
Yeah, I've already put it in.
Jeez, you're organised.
There's Rio.
I thought you were going to say you're in control, and I was going to tell you you're not. Actually.
I'm always in control, even if you think you are.
Yep, he can actually open a trap door down here, so I can fall through the floor at any minute.
Yeah, I've got a lever.
Yep. All right, so looking at this here, we've got Rio. Still looks quite nice, even though it has had a bit of a pullback last month. It's holding up reasonably well at the moment, so Rio's looking okay on the monthly chart. Longer term, still hasn't gone through the all-time high, given that our market's, poised to go back up, and we're looking at a bullish run.
But he was saying they're in an uptrend now. They've moved up, and they're not in.
There's no uptrend.
There's no uptrend on Rio at the moment. What was the other stock? Was it BHP you was looking at?
BHP. I'm not sure of what the other one was, but we can have a look at that one as well if you'd like to. Would you like to?
Yeah, we can have a look at that one quickly and just look at BHP.
Why didn't you put that one in there? Can I ask?
Well, I did, but it's in a different workbook, because you haven't switched to the other workbook. But I didn't want to embarrass you on TV.
Okay. So looking at the all-time highs that we have here, BHP, similar sort of shape to Rio, still below the all-time high, fantastic stock, but at the right time. You can trade this. It's a really good trading stock, BHP. Some people think they've just got to buy and hold it, but we've talked in prior sessions about why you don't buy and hold any stock and look at the decline.
Well, if he's using the rules in my book, now you know the rules in my book because you checked everything that we did in the book.
You'd be out.
I think you checked it about 3 times, everything in the book. But he's just buying in.
Yeah,
so
well, there's no entry.
Has he followed the entries in my book?
Definitely not.
No, he hasn't. So
look, BHP doesn't always work with the rules in your book, by the way.
No, but it was part of the test.
There are other rules which, if you do the course, you'll get to know what they are.
Well, you make a lot more money, yeah. But yeah, right. From what I'm seeing, none of those stocks have fit the rules in my book.
Okay.
So because unless we go down onto the weekly chart, because
we are on the weekly now.
They're on the weekly. Well, you were. Sorry,
there we go.
Didn't see it. So let's move on to the next question.
All
okay.
Right.
So.
Okay,
I am in charge.
Question, he is. Question number 3. Do you want to do this one?
I'll do this one. We got an email from Jerry who asked, Dear Dale, that's nice, Dear Dale, I've read your book, Accelerate Your Wealth. Keep up with me with great interest. I'd like to ask you a question regarding the share trading plan. To buy a share, you recommend that a stock has formed 2 consecutive closes above a downtrend line and vice versa for selling below an uptrend line. So my question is, are the closes on a weekly chart or monthly chart? Interesting question, isn't it?
It's all about
to answer your question, really, it's about Depends on the trading plan that you have. If you're looking, my first book, How to Beat the Managed Funds by 20%, was just one close on a monthly chart, and that worked really, really well, and it will still work really, really well. With Accelerate Your Wealth that you've read, it will depend on your strategy. If you're more medium to longer term and you're just using monthly charts, it's one close. If you're using a weekly chart, it's always 2 closes. It's pretty simple. So monthly chart, 1 close, weekly chart, 2 closes. That's it. Answer to the question, finished. Move on.
Okay. All right. Do you want to keep going?
No. We can look at the chat. So that's your job tonight, looking at the chat. So I'm gonna control the mouse for a second, but you can go and have a look and see what we've got on the chat.
Thanks for that.
And
I've got Todd Martin wrote something. And thanks everybody for the comments on the chat. You're really keen, and it's good to see you all out there. JP Morgan's being investigated for manipulating the metals markets. Interesting, I've noticed that Citi and JP Morgan moving one of my stocks for Norge's bank client. Gotta love it. I'd rather not comment necessarily about that one, but it's a good point that you've raised. It's something that, that there's always some sort of investigation going on about different companies, and I guess that the scrutiny that companies are under is a lot greater since the GFC.
Yeah, it is a lot greater, but then it's like a swings and roundabout, isn't it? It just keeps going around because the scrutiny gets tighter, then it gets looser, then it gets tighter, then it gets
every
looser.
cycle.
It's just a cycle, and that's why booms and busts happen. That's why crashes. That's why Ponzi schemes come and go. That's why all sorts of stuff happens, is because governments go overboard with regulation, and then slowly the industry gets them to push them back and push them back and push them back. And we're seeing a big push in Australia with the financial services industry, with the Royal Commission and everything else, investigations to everything. But the government will eventually fold around and will start easing up things, and then we get back into trouble again. But really, there's always manipulation of markets. I mean, George Soros manipulates the currency market all the time. So don't think it doesn't happen. But what I will say to you is the charts will tell you everything that's going on, because the charts can't lie to you. It's unadulterated, pure fact charts, and that's why we use them. So I don't care who's manipulating the market, it's just looking at the chart, because the chart will tell me exactly what's going on, whether I need to buy, sell, and if I've got rules around it, I don't need to know what JP Morgan's doing at all. I can just trade gold or anything. It doesn't make any difference.
A chart is a chart, isn't it?
The chart is a chart because it comes directly from the exchange, and it lists every single price movement of the stock, commodity, index,
So what you're saying
currency.
is that, would you say you'd be better off to trade gold rather than buying gold?
Yeah. I'd rather trade gold than buy the physical gold, because physical gold you've got to store. And you've got to pay the
a
first
gold
mint to
ETF
store.
or something like that, or
Well, I wouldn't even buy a gold ETF.
stock.
I'd just buy a stock that's probably in gold. I mean, you could buy a gold ETF, but I'd probably prefer to buy gold, a stock, or like a Newcrest or something like that, or gold. You can trade gold on a futures contract as well. So I'd rather do that than hold the physical, or pay for an ETF. But no, it's a good question.
Look, we've got a couple of really good questions here. Hi guys, this is from Michael Seji. Thanks, Michael. What are your thoughts on only choosing stocks that provide dividends for a monthly income? Now, I mean, do you mind if I start on this one?
You can go for that one.
Look, you know what? It's historic, isn't it? That stocks, people have been buying stocks for decades to try to get a dividend income. And that's one of the bait in my mind that tries to lure people in, because over the years we've seen stocks that historically have not paid good dividends turn around and offer up a big dividend. And so then investors are encouraged to buy it, maybe through their financial planner, or they just see the stock and think, oh, gee, that's a good dividend, I'm going to buy that. But the thing is, you can actually make an income from the market relatively simply without having to sit around waiting for dividends a couple of times a year, which is not an income really. It's just you're getting a little bit of a cash windfall each year. So, and the share price does drop when the stock goes ex-dividend, so it's actually giving up the dividend. That's what the X means. And stocks generally will recover after that, but they do often fall further than what the dividend value is. So we actually look at trading for the income rather than waiting for dividends, which are, not as consistently available, if you like.
No, when you're trading for dividend, you can take money off the table when you want to take it off.
Yeah.
And that's where a lot of people
When you're
just
trading
think,
for income.
yeah, and you're trading for income, and a lot of people use dividends thinking it's an income stream, but you're right, it's only paid twice a year.
Yeah.
So
Sometimes
I did a
more,
podcast on this only about 2 or 3 weeks ago. So if you haven't heard,
that's a good idea. They can go
if you
watch.
haven't listened to our podcast, just Talking Wealth, just type into iTunes Talking Wealth or Google Talking Wealth podcast, Dale, and they'll come up. But it was about 2 or 3 weeks ago. But most people, when they're trying to trade for or get dividend income, they go for the highest dividend yielding stocks.
Which are often.
But they're often, the highest dividend yielding stocks are generally quite often the worst stocks to own, because they've got a high dividend yield because they're falling in price so heavily. And so you've got to watch what you're doing. A high dividend yield can be a sign of a stock that's falling in price. And so you're catching a falling knife and successful investing is about capital preservation first and foremost every single time. So if you've got a stock that's falling away, and Telstra was the classic example of this, it fell from 9.22 down to 3.25 or something.
And people kept buying it,
and they're buying
cost averaging for the dividends.
And yet they were losing money.
We actually knew someone who we found out later because they came to us for help, but they actually had only Telstra.
Yeah.
And all their money was in the one.
What's use of getting 6% when you're losing 30% on the stock? That just doesn't make financial sense to me. So don't, our advice is don't just do stuff for dividends. Yes, you might need some income, but buy and sell a few stocks. And as you sell stocks in profit, you put some money in the bank, and that's your income for the next 3, 4, 5, 6 months till you sell the next one. Well, and the dividends become a bonus.
We have clients that ring up and say, look, I want to take $5,000 out of my portfolio.
Yep.
So they're taking the money so they can use that to live off or go and have their holidays.
And that's what we teach traders to do is, bank up some money for your living expenses over the next 3, 6, 9 months. And then as you're trading, you just keep putting more money in the bank. So it's always got, 3, 6 or 9 months, whatever they decide in the bank, it's already there as they're trading and keeping that, and they're just drawing that down. So that's really what we do.
Think outside the box is what we're saying. Don't just listen to what the industry have been prattling on about for years about getting dividends. Did you want to look at one more before?
We can look at one more and then we can get into tonight's topic.
It looks like Desher Wind, I think. Hi, Dale and Janine. I got your book, Dale, on beating the managed funds by 20%, and I'm hoping you can look at Coles, COL, and Lend-Lease. It looks bullish, but I'm not sure if its run is coming to an end. Thanks, Dom. Okay, so
Coles.
let's have a look at that. COL.
Yeah.
And what else have we got?
And Lend-Lease.
And Lend-Lease.
So you haven't put Coles in yet. You've got to click.
Oh, there we go.
There you go. Sorry, you did it.
And Lend-Lease.
Yeah.
It's good that you're keeping an eye on whether I'm doing this right or not.
No, I've got to watch you.
Okay, Chartle. Okay, so we've got COL. You can see there, nice strong uptrend on Coles. So that's looking much better than it was. Now, I don't know if you guys, we've talked to you about this before, but when stocks list on the market, often they'll fall below the issue price within the first 12 months. Now, this is what happened with coal, and then it recovered. So that's why it's best not to own them necessarily in these floats, or to try to buy them in early. Say, for instance, you didn't own them when they first floated on the market and you thought, oh, Coles, I shopped there, I might buy their shares. The best thing to do is to actually wait until the trend starts moving up and then go with the rest of the market, so it's a higher probability of being right.
Do you know why that is?
Why? What is?
Why that happens?
The fall?
Oh, yeah, why they fall.
Oh, it's got a lot to do with institutions and, whether institutions take up the stock or not, and them shuffling their portfolios and the weightings in the institutional portfolios.
Yeah, this is a big stock because this used to be Coles and Myer together.
You thought you were going to catch me out then, didn't you?
No. I was just making sure you're on the ball. I mean, you have been away for a few months, so I thought I'll just test you out. But sometimes when it's a company, it's when's the best time to float your company, and that's when you're going to get the most amount of money for it.
Yeah.
Before it falls away. And we saw that with McGrath Real Estate. It fell quite heavily. And Myer has been falling for years. So that sort of stuff. But that really does happen. So again, don't buy floats.
Well, this is looking quite nice now. If you're in it, I'd stay with it. It's not a buy right now from my book.
No.
But it looks good.
And Lend-Lease?
Lend-Lease.
That looks great, doesn't it?
Yeah, it looks good. I mean, it's just rocketed away here recently, but it's slowing down at the moment. So we may see a bit of a pullback short term on the stock to test this position here. But it may not come back that far, maybe between $15 and $16 part of the pullback.
So let's get on to tonight's topic.
Okay, tonight's topic, go for it. This is exciting. Drum roll.
I love getting into the topic. It's really, really cool. But tonight's topic, which is why the Australian stock market is poised for a record run. Now,
I'm really excited about it. as it means that this week we're going to cut through some of the hype and hysteria that
That's a nice way to say about it,
that we
isn't it?
constantly hear about in the Australian market potentially crashing, to explain why we believe this is not going to occur. And this is some of the stuff that you've been saying in your reports and in the media, isn't it?
I don't know about you, but I'm getting sick of the rumours of recessions, crashes, trade wars, Trump tweeting, and all the negative news. And so I'm really excited about tonight too. And one thing I actually wanted to say is that if anyone watching is purely basing their investing decisions on fundamental analysis, then you need to be aware that both Jenny and I are technical analysts, and that's what we do, and what we share with you is based on this. And all too often I get comments from people saying, well, the fundamentals says this and the fundamentals said that, so, and sort of saying that we're wrong. And it's not wrong, it's just what the fundamentals are saying. And fundamentals generally lag what we're seeing on the charts. The charts are the leading indicators of the economy, and the market is the leading indicator of the economy. And the economic news and the economic data changes after the market's already changed. So what we're looking at is timing the market and actually working out, is the market moving up or down? And I don't know about you, but how many times have you had somebody who's a staunch fundamentalist that tells you you're crazy, and then within a few years of dealing with you, they've changed completely?
Yep, over the years that has happened a lot.
It happens a lot.
In the media, when you're getting interviewed, they'll often have been speaking to someone who's been talking about the fundamentals, and then you've got a different view. And it's I guess it's good because we're trying to balance out the perspective out there.
Yeah, and that's all we're saying to you. So you may have different views of the market or what's doing. That's okay. This is our view of what we're talking about, and we're just showing what the market can do and what direction it is, and looking at that bigger picture.
And tonight we're going to show you why we don't think the market will crash, and to do this using Dow's phases of the market, which helps us determine the direction of the market. This week's topic's also designed to build on the knowledge that you learnt last week about how to identify trends in the stock market. Hope you enjoyed all of that.
I did.
Charles Dow, the main man, who established the Dow Jones Industrial Average in 1896, was arguably one of the first analysts to truly define the commonalities found in bull and bear markets. Interesting person, this one. He discovered that certain measurable trends evolved in the stock market over time. Now, unfortunately, he passed away before he was able to quantify and publish his full findings. Despite this, a number of Dow's associates combined his various workings into what we know today as Dow Theory.
Now, according to Dow, there are various stock market trends and patterns that unfold over time. However, the principal focus of his work is to identify the primary movements of the market, or what is referred to as bull and bear market. So that's what he came up with. Now, each primary trend encompasses three phases, which reflect the market behaviour you were trying to identify. But it's important to understand that the market behaviour is dependent on the time frame that you're viewing. So take a short-term view of the stock market trends, and you'll see why the experts are claiming doom and gloom, because they're looking very short-term. As in every bull market, there is a reaction that causes prices to fall away. But when you take a longer term view, and you'll see why the Australian stock market is poised for a record run, as after each move down, the market rises to higher levels until the bear market starts.
So let's get into looking at the weekly chart of the All Ordinaries Index. You can see that I've marked several areas where the relative phases of the market appear to have completed, and the left side of the chart was a phase that looks to resemble rampant speculation. This image is early in 2017, and in a minute we'll bring up an up-to-date chart to show you what has transpired. Given that we're using a weekly chart, it's important to understand that the analysis only reflects the short-term medium view, which is up to around 18 months, although this is not a hard and fast rule. Later, we'll share the longer-term view of the monthly chart, so it's a bit opposite to what we normally do, but we have got a good reason for this. So let's look at each section on the weekly chart in more detail. The GFC and subsequent major low into March 2009 was the end of a primary bear market. That's what it's called. For those of you who understand bear and bull markets, it's going to be much simpler. For those of you who are new to this, it's just something you need to listen to carefully. As Dow observed, the final phase of the primary bear market is distressed selling. So that's the end of the cycle when everything's getting sold off and we see a crunch like what we did in 2007, 2008. In other words, all of those who hadn't yet sold, who have given up hope of a return to higher prices and started to exit the market. Now this can be seen in the chart with the sharp fall over 8 weeks. So 8 weeks in 2008, November 2008, the market then rose slightly for 7 weeks in a secondary reaction prior to its final fall into March 2009, just 9 weeks later. So it all happened relatively quickly, but the initial fall was a signal, very big signal. So around this time, educated investors would have been preparing to re-enter the market, but how would they know the right time to enter? Part of Dow's research actually involved determining the patterns that signalled the end of one primary trend and the start of another. You're going to be glad that you tuned in tonight. In the case of the start of a new upward trend, Dow observed a new upward trend will be confirmed when the market doesn't move to a consecutively lower low and high. In other words, a new upward trend is confirmed by higher lows and higher highs. Now the opposite is true in bear markets, where a new downtrend is confirmed by lower highs and lower lows. It is the understanding of this simple insight that separates successful investors from the not so successful. Now, if you recognise the beginning of a new trend, you'll be in a far better position to profit from a trade and your results will improve dramatically. It's a simple thing. Now, I've marked the first instance where a higher low was confirmed. Now, this is the first box following the 2009 low, which indicated that the market was returning to an upward trend. This could also be considered the start of the first phase in a new primary bull market, or what's termed as renewed confidence. A secondary reaction into the 2011 low, which is point B, the second box, followed the peak of the first phase in April of the same year. So you got all that? Notice how this low took out the prior significant low at point A. Some may have taken this to be a return to a primary bear market given the significance of a pullback. However, the accumulation of consistent higher lows and highs into point C indicated that a return to higher prices was likely. Smart investors would have seen this and begun buying top quality stocks, as we can see the market traded significantly higher over the next few years, breaking the April 2011 high and travelling in what appears to be phase 2 of the primary bull market. Now this is the improved earnings phase. So I can remember telling people at workshops that this is what we're heading into, but people couldn't see it at the time.
No, they
because there was so much doom and gloom out there still.
Correct. They couldn't see the wood for the trees,
Yeah.
and they were clad in their judgment, or emotionally clad in their judgment, by listening to the media, which is what was happening in the last couple of months.
Yeah, but I was trying to say to people, you have to trust the patterns until they tell you otherwise. Don't listen to the noise. Just trust the pattern.
Yeah, well, they were asking me, "Why? How are you so confident?" I go, "No, because that's not the market. The way the market's unfolding, or the patterns the market's doing, is not telling me that it's going to fall away." And people went, "Wow, you're magic." No, I just follow this Dow phases. It's pretty simple. And it's our roadmap to where the market's unfolding. Now, we're doing this at a really, really high level right now. So, we don't expect you guys to grab this. But we do spend a lot of time on this in our course, in our diploma course with our students. So you really understand the direction and how the market's unfolding. And you'll remember I've said so many times over the last few months, we talk about price, pattern, time. So this is pattern analysis and helping us understand where we're going to. Because if we know where we're going to and we know how it's going to unfold, then it takes a whole lot of the fear and risk out of the whole market.
It's a roadmap, isn't it?
It's a huge roadmap, and it's like going from Melbourne to Sydney.
Yeah.
First thing you do is work out how you're going to get there, and that's exactly what we do.
Yeah, so the sky could be falling in, but Dow's phases rules. So the high in April 2015 was possibly the top of phase 2. So as the market fell into February 2016, now this implies that we should see a third phase in the bull market before moving into the next bear market. The market moved up strongly from the low in February 2016 in what seems to be phase 3. So we need to look at this and you should be able to see this on your screen, which is the rampant speculation phase of the bull market. Now, that said, remember we have used a weekly chart in this example. It's important to remember that all movements in a market are only movements of lesser degree of a larger trend. Think about that.
Now, given that we know that all movements are only movements of a lesser degree, then we can assume the upward move since March 2009 is likely to be phase 1 of a much larger move, and you can see that in the monthly chart on your screen right now. So Janine, let's now bring up a chart of the All Ordinaries Index that shows everyone what's occurred since the end of these charts up until today, and then show them what we think, or should I say, how the All Ords will unfold into the future. Because what I know is that when we draw, and they've seen me draw, if you've watched some of my videos, like my Monday videos on the market, they've seen me draw these trend arrows, these arrows, where I think the market's going to go. And people go, wow, it's doing roughly what you said it was going to do.
Yep.
And and then Jim Beach in the US says, Dow, you're getting it right. All I'm doing is using my knowledge of this theory and my in-depth knowledge of this theory, just going, well,
and
how does the
cycles
market and cycles and the time, price and pattern, using my knowledge of that and going, well, it's likely to do this. Now, it may not be 100% accurate in terms of exactly when the high or exactly when the low is going to happen, as you hear me say every single week. If the low happens here, the high is going to happen here. If the high happens here, the low will happen here.
Yeah, because you don't need to be precise to it. You don't need to quote a figure on the market and say that's what it's got to be. I mean, that's just overcomplicating it. Like Dale's saying, you just need to follow a pattern about how you think it's likely to unfold. And then when it does unfold that way, then you know you're on the right track and you just continue that process.
Correct. It's just about how, and I think sometimes we get these guys that go, oh, I think the market's going to hit this price, and so they're so fixated on that.
Yeah, who cares?
Who cares? You're not trying to buy at the lowest price, the very lowest price, and sell at the very highest price, because that's so hard to do. You need to put a lot of work in to do that. But
it gets a lot of attention, though, doesn't it, when people quote levels on the market?
Oh, they do, and that's the thing. And some
asked.
people say, "How do you think this will go to $10?" I go, "Yeah, good, could go to $10, but it could go to $12."
Yeah.
So, but what are you going to do? And to go back to that gentleman or person I was speaking about earlier about where that stock was going to go, and I said, even if I said to you it's bullish or bearish, it's not going to change what you're going to do. You're still going to hang on to it. If I say it's bearish, you're not going to sell. If I say it's bullish, you're still not going to sell it. So why it's a bit of a moot point what I think about the stock.
But knowing how the market unfolds actually allows you to make decisions about what you want to do with your portfolio, not worrying about levels.
Correct. So looking at the chart, so what we've got on the chart of Optima, we've now got a monthly chart, which is current data, which is today. So it's got today's data in it, and we can see it goes right back to 1982, and here's the GFC low here. So if I just scroll that up so they can see the more recent stuff, I've just used a few lines, and this is what Janine was talking about in those earlier charts. And so we've had these secondary moves. Now, we've had another secondary move here, so it was going to go up. And all we're doing now is on a smaller time frame having a secondary move before it moves higher again. And so we are looking at this market saying it's still bullish, because that's our previous all-time high back there at 6873. And in July, 30th of July, we just beat that. So looking at Dow's phases of the market, this really is just phase one of Dow's phases of the market. So we still got a long way to go, or we think the market is longer term bullish. Now, I don't think the next biggest fall in our market's going to happen till about 2023, 24, in that bracket somewhere in there. So I think the next 1 to 2 years is still going to be quite good on our marketplace. And yeah, that's factoring in what I'm seeing on the chart. And as I said earlier, it really is talking about what the charts are telling me and what I know and how things unfold on the charts, and that's really what I'm talking about. Yes, there's lots of debt in the world. Yes, there's low interest rates around in the world. Yes, there's China trade wars. Yes, there's all sorts of economic and fundamental things. But like I was chatting with Jim Beach, I think it was last week on the US, he goes, look, there's people talking about bad news, but the news is not as bad in the US as what people are making out, and it never really is. But as Buffett says, buy in doom, sell in boom. This is the time to be buying and really do work on that. So, but I look, it's great. But let's now get back into, I think we've got to get back into the charts again now. Oh, sorry, the chat form doing. Yeah.
Look, I've got a question here. Hi, Dale and Janine. Thanks for the great content. This is from Brian Law. Love your show as always. Just want to know your thoughts on buying New Farm. Looks like a medium-term trend is about to begin.
I'm only joking. I like that stock. Don't buy it, because I might. No.
All right. So there's New Farm. Now, this has really been labouring for some time.
It has.
We've been watching this for a long time, and really were turned off. And there was some controversy around New Farm, and there was potential takeovers, and things went wrong for New Farm. But look, the price seems to have settled at a really important level now. The $5 mark is an important level for the stock. It's trying to recover. I think it's starting to look quite nice. You'd want to have some really nice, strong rules on it. there's no confirmed uptrend just yet, but it's starting to look good in that direction. So if the trend turns to up, then it would be an indication that the medium-term trend is likely to continue in the upward direction. So it's a stock that we like. Plain and simple, isn't it? You've just got to have good rules on it and do some back testing.
So who's next? Who's the next victim?
Next victim
I
is...
like this. I don't do much, do I, when you're doing this?
Okay.
That's pretty good.
What's your opinion? This is from S. Anthony. Hi, Dale and Janine. Been watching for a while now. Oh, thanks very much. What is your opinion on the proposed banning of CFDs and any effect it will have?
Look, I did a podcast on that yesterday, mate, and there's a discussion paper all out by ASIC at the moment. I don't think they're not going to ban CFDs. What they are is changing some of the rules around what the providers can do and how they treat individuals now.
Which is great.
I don't think the podcast went out today. I think it's going out next Tuesday in our e-news report, I think. I did 2 podcasts yesterday. One went out in today, and I think the CFD one is...
You're just keeping them informed?
Actually, no, it went out. I think it might have gone out. So if you haven't seen it, go into, as I said, it's a podcast. I talk about the whole thing, what the ASIC's doing and what the criteria, I think there's 6 or 8 different criteria. It's about how they're quoting, what their platforms are doing, what they're, how they're marketing those, not offering incentives, a whole range of things. But I don't think they're going to ban them altogether at all, because really a CFD is just a form of futures contract. It's simple. There's nothing too much about it. And by cancelling them or banning them, then it's going to push more people to the FX market, and I think that's bad. I think people should be looking at the stocks and having CFDs on them, but I don't think it's going to. Any of the changes will take effect after, sometime after 1st of October. But I don't really know what it is.
Just for people who don't know, CFDs are a contract for difference, and we're basically talking about leverage. So it's a contract over the underlying asset, which could be a contract on BHP or Commonwealth Bank or whatever the stock is or market. That's okay. Look, I'm just appreciating people who are at a different position in the whole journey.
Well, if you don't understand them, then there's no way known you should be trading them.
No, and look, some people think that they know how to trade and then they go and trade the leveraged markets before they've just traded cash. You'd be better off trading really small amounts just in stocks just to get started. And then when you actually are successful for a year or 2 in stocks, then move into the CFDs. I really can, I can say from my experience and from the experience of watching other people, particularly around the GFC when all that was happening, there were a lot of people who were just jumping into CFDs because they could get access to the money. They didn't fully understand what it was. It was like this new novelty thing on the market, and it was just leverage to us. It was just using borrowed funds to us.
Yeah, but I don't know how many times I've spoken to CFD providers or FX providers
and the turnover.
And the turnover of clients they have, and it's a fantastic turnover. It's a great business model because people just give them money and then they end up, it's in their revenue for the year because I've met and been in every CFD provider, and every week a new broker's approaching us for us to recommend people to them, and I keep saying no because brokers are aptly named from that point of view, but I find people go out and try and trade CFDs and FX before they even know how to even spell CFD.
Yep.
And all they're doing is they may as well just write out a check and give it to their broker because that's what they're doing, giving the other side. And 90% of their clients lose money right across the board. And it doesn't matter who the provider is.
They'd already started to tighten things up when the commission. Oh, I know.
Years ago.
Just hearing some of our students who actually trained in trading, who told us things that were happening with some of these CFD providers and big name brokers that they would set default settings in the system, and so if you didn't know what you were doing, you would get caught out trading an over the counter. CFD instead of a direct market CFD, which there's
But they don't tell you. The average person opening a CFD account or FX account does not understand that they've got different classes of clients, and depending on what class of client is how they treat you, and not talking about whether they make you a cup of tea. I'm talking about how they treat you as a trader and what they do with your trades.
Yeah.
And they do have settings in the back end of their software to click on it. If they don't want you to make money, you won't make money. That's how they do it. And it's perfectly legal because they've got parameters they're allowed to work into. but you need to be a lot smarter than them, and that's really the point of it. But let's have a look at another few more questions, but great question anyway, I thought it was good.
Yeah, look, there was one here from Harvey Norman. Anthony. Thanks, Anthony, and thanks to all you
from
guys.
From Harvey Norman?
On
Jerry.
Harvey Norman.
Oh, on Harvey Norman. Okay.
Jerry Harvey's a classic, isn't he? But thanks to everybody for the comments, that you're making some great comments here, and just for appreciating the show. We may not be able to get to all of them. We're doing our best. So, Anthony, hi guys, looking at jumping into Harvey Norman, trending nicely. Looks like it broke above a resistance level. It does. So I've got Harvey Norman. If we can just switch to the chart there on the monthly chart, you can see the long-term picture for Harvey Norman. There's this high here at 459. And prior highs here in August 15 and so on, which I think that level around 460, 480 could be a little bit of a headwind for the stock in the shorter term, but it's looking good bigger picture in terms of its push towards the all-time high. Nice uptrend there on the stock so far. But notice how the number of bars moving up, it's sort of slowing down a little bit, and then the moves down on the downside are getting longer. So that's something to watch for, to see whether it's really got the momentum to go higher or not, or whether it's going to slow down.
How do you think the rights issue, is it rights issue they've got happening in the next few weeks?
Yeah, that's a really interesting one.
Is it a rights issue?
Yeah.
I know there's a corporate action.
Yeah, it's a really interesting one, that rights issue. Because the price that they're quoting to pick up the rights is $2.50.
I know, it's way down.
It's way down. So look, it'll be interesting, but it's only a small percentage in terms of the overall value of the stock.
So it may cause the amount of capital fall away for a week raising. Or two.
Yeah, so it could actually come back as part of these rights issues when they're announced. Yeah. Okay. So we like Harvey Norman. That's the bottom line. Oh, you want me to do another one?
Yeah, I want you to do 5 or 10 more. Like, these guys are paying big money to do this, for us to do this. So
okay, here we go. What impact on a share price does a share buyback have? This is Brython. A really great question.
Generally supports it. It basically holds the share price up. Because obviously they're taking excess capital and they're buying back their own shares now. There was I did a podcast on it. I'm doing podcasts on everything, aren't I? I did a podcast. I did it last week, I think it was. It was on...
full of knowledge,
I'm just full of it. But I did a podcast I think it was last week, basically commenting on Josh Frydenberg came out, our federal treasurer came out and talking about companies not being short-sighted and not thinking about productivity and growth. And it was all about there's all these buybacks and extra dividends and things like that. And so I did a podcast on that. So have a watch of that again.
So it's designed to keep shareholders happy, particularly institutions.
Correct. It's not about growing the business. It supports the share price so that the management gets more bonuses pretty much half the time. Because if you've got all this extra capital, why wouldn't you grow your business by putting it into something that's going to reap benefits, 2, 3, 5, 10 years down the track for your company. Yeah. But what they're doing is they're pandering to the big end of town and paying out dividends or buying shares back to push the share price up. And a big broker, fund manager, once told me what happens on the back end, which, it's business, I guess, and they're a big shareholder, so therefore they can put the screws in and try to influence what's happening. They do.
Yeah, well, I was wondering whether that had an influence on what Jerry Harvey was doing with the rights issue and the way that that was all set. So that would have been designed by some broking house.
I know annual shareholders meeting is just a foregone conclusion before they walk in the door. Yeah. The management team, there's a whole statement is no surprises. There is no surprises on a shareholders meeting. So everybody goes and talks and gets on the microphone, but everything's decided before they walk in the door.
Well, that's actually one thing I like about Jerry Harvey. He's a bit outside the box.
He is.
So, and he really challenges them and doesn't necessarily pander to. In the past, he hasn't pandered to them.
No, should. Keep going.
So looking at that, you talked about the buyback. What impact does it have? And the next question, Joe McGovern. Thanks, Joe. Do you think IMF is just about to retest a recent high and he's got a price in there of $3.50? So let's just have a quick look.
I don't think I've looked at this one.
Okay, IMF Bentham. Looking at this company, we can see that there's a really nice strong move up out of this resistance level that it's had in July 2019. But often when companies move to, or share prices move to new highs, they'll have a retest, which is what's happened here. So looking at the monthly chart, it's still pretty obvious,
I think it's pretty hard, isn't it?
Yeah, but it looks nice, bigger picture.
It's closing high already this month.
Yeah, so looking at it now, I'm just going to have a look at, we've got volume on this so we can see what's happening. Looking across the board, so say there's about 1.2 million, say, shares a week. Overall, it's a reliable figure, taking out the peaks that are in there. on a $3 stock or $3.20 or something.
It's pretty reliable.
Yeah, but it's not a huge company. So it's a smaller company. So that's something to bear in mind in terms of liquidity.
2 more stocks.
But it looks nice at the moment.
2 more questions.
Okay, 2 more
and
questions.
And you'll squeeze 3, right?
What are your thoughts, Paul? Thanks, Paul. Hey Dale, what are your thoughts on EOS? It had huge growth. Is this sustainable? All right.
EOS.
Yeah. So let's have a look at EOS.
Okay. I don't think I've seen EOS in the last few weeks.
Okay, electro-optic systems. I think we looked at this a long time ago.
Yeah, we did.
So this has just gone ballistic. Now this is a sideways consolidation.
Does he say whether he's in it? Or should I stop interrupting
No,
you?
he just said, what are your thoughts? It's had huge growth. Is this sustainable? Now, generally, no, these moves aren't sustainable, especially for these sort of more illiquid type stocks. So the idea is to have a relatively tight stop loss on something like this, but sometimes they can keep going. So you don't want to cut your profits too short. Think about what's the best way to manage this.
If you're not in
forward.
it, don't get in it. If you are in it, set a stop loss.
It's not a stock I would use with a trend line actually.
No,
at all.
You need other rules for trading this one. Next one.
Next one. Okay.
I'm going to keep pushing here.
Can you please check out Worley? That's Geppert.
I like Worley.
Have I pronounced your name
Geppert,
correctly?
Yeah. He's a regular. Hi, Geppert.
Yeah. Hi, how you going? So where have we got? Worley. That's a really great stock. Good choice.
About a month ago, I did a contrasting between Worley, Monadelphous, the Aussie dollar, and commodity prices for our students.
Oh, that's
I
good.
did a whole recording on that. So
but
that
these guys don't get to see it. So you're just you're just hanging a little fish out there and then dangling
it's a carrot.
a carrot.
It's a carrot. I don't like fish; they stink. I have a carrot.
Is that why you run away when I get the sardine
Absolutely,
tin out?
you get sardines all the time. And look, Janine has her lunch sardines.
It's healthy.
I know it's healthy, but it stinks.
Okay. Now, looking at this, you can see here we're talking about more than stocks. Worley, we've got resistance across here. Now, this is something that's really important to understand. So this is the price side of the analysis that we're looking at with Worley. So bigger picture, we like the stock, but short term, it's down. It's made a lower low here. So I wouldn't be, liking it right now. Yeah, too early at this point. But if you're in the stock already, you better have a stop loss just in case it decides to go south.
Cool. Last one.
Yeah. Okay, I better shut up now. Next one, we've got Dale and Janine. It would be great to hear your thoughts. This is Ben Edwards. G'day, Ben.
Hey, Ben.
On EML. It's a company I was watching for a while and I got in at around 360 after they reported strong results, but they've pulled back slightly. Ben, I hate to tell you, but that's no surprise to us. That's what happens after companies report. Yeah. So if a company reports good results, historically, I can remember reading the Shares magazines when I first started. This is a long time ago. I don't think it even exists anymore, does it?
Yeah, it does.
Does it? Oh my goodness.
No, it doesn't. It all got merged. Shares got merged into...
I think I kept a copy, so I should dust off the cobwebs.
Money
and trade.
magazine used to produce Shares and they got merged into the one.
Yeah, okay.
So look, all come from Channel 9.
And you realise later on that you're getting the news when it's too late. But look, depending on where you bought it, it's done really well. I think you said it's just pulled back since you've picked it, which is fine. I mean, it still looks good at this point to me. Until it pulled back, I'd say, look, I'd be a bit concerned about it if it starts coming back into the $3, $3.20 mark, but at the moment it's all right. I'd expect a bit of a move down, temporarily at least. So that's EML. Then we're looking at, you said I got one more.
That was your one more, wasn't it?
No. You said I can do it. Yeah. James Neville. Hi, Dale. If you set an initial stop loss when purchasing a share and then the next 2 weeks it closes below the trend line, is that a point of sale?
That's not your stop loss.
Initial stop loss when purchasing a share, the next 2 weeks it closes below the trend line. So I think they've missed something here in terms of initial stop losses and trailing stop losses.
Yeah, because if you're buying on a trend line, how does it close below the trend line unless it's triggering your stop loss anyway? So again, your stop loss is 15% below your buy price.
That's a guide.
That's a guide. But
you come and do our course and then you'll understand exactly how to set the initial stop loss and when to use a trend line.
Always, when you first get into it, set your stop loss. And if it trades below that, get out of it.
That's your risk management.
Yeah, just because a stock comes below the trend line doesn't necessarily mean you need to sell it, because it might only come below it a little bit during the week and then go back above it.
Well, the other thing is it may not have a current trend line.
Well,
or the trend line could be miles away from where your buy price was, and therefore it might not make sense to use it. So there's all these sorts of things anyway.
Yeah, there's lots of variabilities, but I think we've finished the show.
We're
just at the end.
Just getting started.
I know you get warmed up. So, but hope you've enjoyed. Jeez, you're just getting started. Yeah, well, you've been away for 2 months, so you're raring at the pit.
Oh, look, there's so many more questions. There's some great questions in here.
But we just don't have enough time to do them. So, because
Okay.
I'm on holidays from tomorrow morning. Actually, I'm on holidays within about 3 minutes. So, but hope you've enjoyed tonight's show, and thanks for participating. Remember, really to show your support for what Janine and I are doing, and share this show on your social media with your friends and colleagues. Like, the more you keep sharing it, the better the show is. And remember, hit that subscribe button down there, big red one. Hit that one so that you're showing your support for the show. But next week, I'm not going to be here as I'm on holidays week. I'm heading off to the Philippines for a bit of business, and then I'm sitting on an island for about 8 days while Janine does all the hard work, because I've been doing it for the last 2 months. So you're going to have a very special show with Janine.
Also, make sure that you put this show on your calendar so that you're back online next Tuesday at 7 p.m. If you cannot be with us live next week, we're always happy to receive your questions, so send them to info@wealthwithin.com.au and just type Wealth Within Live in the subject line.
Well, that really does bring us to the end of the show. Now, we hope everyone has enjoyed it as much as I have, and as always, thanks for taking part. We'll see you again next Tuesday at 7 p.m. So goodbye, good luck, and good trading.
Good night, everyone.